Good morning, everyone. I hope everybody is doing well. So let us start. So last time we stopped on the risk analysis on the Monte Carlo analysis, and we did some projection of the question. I would like to go very quick over what we have done so far and proceed with its interpretation. Would you like me to go like again from the beginning, the calculation of the Monte Carlo analysis, or with just revision? Just can I get your feedback, please?
Just revision.
Okay, that means that you are already good. So now we have given these data parameters. Like the useful life is 6 years, investment in fixed capital is 300, and investment in net working capital is 50. Depreciation straight line is 50.
Could you please share your screen?
Didn't I? Okay, no, I didn't share. Thank you so much. Okay, now I shared. So we had data parameters. This like useful life of the project was 6 years, and investment in fixed capital and investment in net working capital was 350 respectively. And depreciation straight line was 50, like for 6 years, and unit price is $5. 40 units was produced like in first year, and we said that the sales will grow by 5% with a deviation of 1%, but it will start to grow from the second year. And variable cost per unit was 1.5, and expected salvage value is $60. The tax rate is 40, and required rate of return is 12. So what we did, we just tried to create the growth rate first of all, but we create the growth rate in a way that it changes every year. So it's kind of unpredicted growth rate. So kind of we're trying to simulate a real world, okay, the real market, because we cannot predict how much it's gonna grow, but we can make an approximation, but with some deviation. So if you just with the formulation what we used, it's okay. Now 3.73, and all the time it changes once we just press F9 or just click enter on the cell that we created here. So in accordance with that, we said the sales is 40 units produced, sold, and it's starting from year 1 to the year 2, it's gonna grow with the growth rate 3.73, and it will proceed in this way. And then revenue is found like price is the price times the sales. This is what we get it. Price times the sales amount and corresponding sales amount, and we just proceed it, and it goes with for the 6 years. Then we put the variable cost, the like variable per unit times sales. We get 60, and so on. It changes every year. And 50, its depreciation is fixed, and we derive the EBT, earnings before interest tax, and we get tax, which is 40%. We derive the amount, and we proceed. And operating cash flow after the tax is 54. And depreciation we are adding back, and the reason why we are adding back, we already mentioned several times this, because of the non-cash item, and in order to get into evaluation or into operating cash flow system, then we need to add it back. Then at the final stage, we said when we finish the project is like over, we have to sell the equipment that we purchased to produce the units that we're selling now. And the amount is sold, it will be the salvage value will be equal to 60,000. That's gonna be added. So we have to think, we have to take into consideration the salvage value minus, because when we sell it, it's kind of gain, we have to tax it, and we subtract it. Apart from that, we're gonna add the change in net working capital. That change in net working capital gonna be kind of return on investment. Okay, we're adding back these things are already we done it. Okay, we just proceed. So after that, we derive the cash flows, the projected cash flows, but the projected cash flows comes in the way that we are not predicted. Okay, because why? The growth rate is changing. And we gave a command to Excel that the growth rate will change randomly selected numbers that will deviate around 5%. Okay, that will deviate around 5%. We know the growth is 5%, and it's gonna be with a standard deviation, it's 1%. So they're gonna be around like 1%. That's why we get always all the time unpredicted cash flow. Sometimes you may be finding out that the NPV is equal to negative number. So in some cases, so then we said the main purpose of using the Monte Carlo analysis is to come up with a certain outcomes, like as much as possible. Like we said, we're gonna use irritations of number, let's say 1,000, but it can be done in 10,000 times. So we're trying to get 10,000 different NPVs. But in here, we try to get 1,000 different NPVs. But how we did it, we just create the sample from 1 to 1,000, then we put the NPV here, okay? We select all we set. We go to data, and we go to what if analysis. In the column cell, we put the NPV column. If you put it row, that it's going to calculate the what if numbers for rows, but we would like to get it for columns because 1,000 different NPVs, okay? And then we press OK. It's recalculated. Then we come up with a statistic, descriptive statistics. Like this descriptive statistic is the last stage. It is very important, and this is the thing that we're going to interpret actually on the result on this Monte Carlo analysis we did it. So this is the main part that we're going to make some interpretation, okay? And guys, one more time, I'm telling you, in the exam, I might ask you, calculate the payback rule, calculate the profitability index as well. But in here, we don't calculate because it's, you know how to calculate, I taught you, but just with a matter of, to be more efficient and quick in the explanation, I'm using like IRR and NPV, okay? So now we go for data, we go data analysis. In here, you choose descriptive statistics. By the way, you can do the regression analysis as well, but we choose the descriptive statistics. Then we press OK. In here, you can choose create in the new worksheet or create in as an output range in the same worksheet that you're working, or create a new workbook or new Excel file to open it. So it's up to you. But then the second stage that you choose is the summary statistics. This is what we needed. And the input range that you're going to evaluate is this. We would like to evaluate the NPV. Okay. It's from D43 to D4 to D1042. And if I put the new worksheet, it's going to create a new worksheet to me. And we're going to have it in the new worksheet, that's data statistics. So it takes a little bit of time to explain it, to derive the descriptive results. Actually, these descriptive results can be derived using different softwares, like apart from the Excel, like Stata, SPSS, eViews. These are the statistical econometrical software that are used, and actually to get the results quickly, and they will give you in the quickest manner, okay? Okay, this is what we get it in a different worksheet, but let's return to our own worksheet. Please, guys, tell me if you have any questions, like if you lost in getting the things done. Okay, now I think I already uploaded this into Moodle. You can just follow up. All the comments are given in Excel. You can just easily follow. Now, in here, okay. Now, first of all, let us start with mean. This is what we're going to interpret. This is what exactly we needed. It's just average. This is what we exactly needed. This is important thing for us. And the interpretation it will be in the following way. We would like to compare with the average of 1,000 different NPVs is one. So on the average, it is $161. The NPV is positive in here. And if you compare with the derived NPV with no any averages directly, what we can see, there isn't much difference, okay? There isn't much difference. So let's get a difference between this and this. This minus this, the range. Okay, it's $3 of difference. Okay, just $3 of difference. That really is good. That means that all 1,000 different scenarios of NPV, it's not deviating too much. So it's kind of giving us information that we are controlling the whole project. So if the NPV changes, it will change on average by $3. Okay, this is the change in actual change between actual NPV and average NPV. So it's good. It's not that big. So the smaller the number, the better the position of the company it has in the terms of the projecting the cash flows, in terms of getting the NPV. So that means that underlines the reliance, the validity of the project actually. Then we move to standard deviation, by how much it deviates. Actually, this number, the lower the number, and guys, don't look at if it's negative, okay, in here. So in here, it shouldn't be too much big, okay? Like by 1,000 or 2,000 deviation, or but it can be negative. That means that shown like the difference between the average and that thing. So the standard deviation is can be considered low as well. Then we go for, so we need the standard deviation explanation here, okay? So it's low, the riskiness is reduced. So the lower the standard deviation, the less the risky the project is actually. The lower the standard deviation, the less risky the project is, okay? Then we need to interpret, there are two things as well, kurtosis and the skewness. Kurtosis and the skewness. There is this range, actually we are looking for to have the NPV in the range of the normal distribution. How can we understand? We can understand if the kurtosis and skewness gives you some numbers, and that falls in within that range number. And that range number, according to the George and the Mallory, that has been published one article regarding this kurtosis and the skewness. So in accordance with George and Mallory, that published the paper. I'm sorry guys, just a second. So according to the Mallory, that 2010 was a publication actually. These guys are the scholars in the field of econometric and statistics. They said that for the kurtosis and the skewness normally normally distributed, like in the acceptable range, the skewness should be from -1. Let me type it. From -1 to 1. That means this range, this normally distributed the distribution of the NPV is normally distributed. This is what is acceptable range. So that it gives us a positive sign about the project. Okay, this is in accordance with the George and the Mallory 2010. Okay, and another one, coming to the kurtosis, they said that for the kurtosis to be in acceptable range, it should be from -2 to 2 to 2, okay? That means as well, whether it's in that range or not. If it's like, say, more than 2, it's around 3, or less than -2, which is -3 or -4, that should give you indication of, there is indication about the validity of the project. So that means there is something wrong with the distribution. That means that you might expect anything that may disappoint you at the end, actually. That you may end up with a negative MPV, and you may end up with a big loss, actually. So really that makes a big problem. So these two indications are very important. So what we do here, we need to consider these things. And this, whenever you interpret, you always should refer to these guys like George and Mallory, because scientifically, in order to explain something, you should come up with a certain feedback. Why you're sent like from -2 to 2. So why you said this is the good range? Because these guys, George and Mallory, they made the research and they come up with the empirical results. They said that kurtosis and the skewness for a project to be normally distributed and to be accepted in a specific range, these are the range that are provided, actually. So these are the range that we should take into consideration, okay? So another point in here is that another scholar, which is Field, he published his paper. He did the investigation, empirical investigation in 2009 as well. So he has come up with the same conclusion like George and Mallory. Okay, these two things should be fall in the range from -2 to 2 and from -1 to 1, like kurtosis and skewness respectively. And then we go for the range and the minimum. This is what we are interested in. The range as well, what we can see by how much it deviates, okay, the range. On average, like the range between this average and each, it deviates by 29, so it's not a big deal, okay? The range actually goes from the least MPV to the most highest MPV. The minimum is 146 and maximum is 176. That shows that we don't have negative MPV in our 1,000 scenarios. If it run 10,000 scenarios, then we may have it, but in 1,000 scenarios, in 1,000 MPV, it gives us a positive indication that shows that we don't have any negative MPV as a minimum number of the MPV, minimum value of MPV, and the maximum is 176. So the worst case that could happen to this project, you would end up with a $146,000 of MPV. It is the worst case that could happen in 1,000 scenarios with these certain conditions. But when it comes to the maximum amount, it shows that the maximum, the best point that you will be able to reach with these certain given conditions is 176,000. So then we go for this count. The count is showing how many samples we used, like is 1,000, the 1,000 iterations, that 1,000 sample we used it, okay? So this is the explanation that you should come up. So as a conclusion, you should come up with the decision, yes, I should accept this MPV because this is the case and this is the reality that I get it. I should accept the project with this MPV. Do you have any questions?
Sorry, can you explain again about standard error?
Standard deviation, yeah?
What about standard error? What does it mean?
Where is standard error? Okay, we don't need, no. Standard error, like it's showing each variable, it has gone its own error, but we are not interested in these things. Median error and standard error, we are not interested. I already highlighted the things that we're interested in to get the necessary information, okay? Mean,
okay,
standard deviation, kurtosis, and the count. That's it. This is the thing that we look for. We don't need standard error, median in here. That if you're going to do the regression analysis, the correlation, so on, we might use it, but still we don't need it, okay? Later, when you just finalize everything, I will teach you to do the regression analysis. It's very important. But now you should understand this is the project and how to come up with a certain project. And then this is the explanation. So the risk analysis has got three parts: sensitivity, scenario, and Monte Carlo. So these three analysis, you should do it for a certain project, and then you should come up with a certain decision, whether you should accept this project or not. So the project can be, as you remember, at the beginning of the class, I explained to you the categories of the capital budgeting. Like one is the replacement, the other is the expansion of the project. The third one is the new products, and there's some mandatory project like related to the governmental requirements. However, now we are dealing with the expansion, new products. So the calculation of the new projects, the calculation of new, the projection of the cash flows and evaluation of the projects with expansion and the new products are similar, but a little bit different with the replacement cost. Okay, replacement cost is dealing with the incremental values. But when it comes to the mandatory projects, it's a bit different. In here, we're not calculating the value that gives us in terms of monetary, but in terms of cost saving, in terms of utilizing, in terms of getting the benefit by using it, not in terms of the money, not in terms of the profit, okay? So we are now dealing only with expansion, new products, and replacement. Do you have any questions in here? Do you like me to explain it again, or if everything is clear, let me proceed with further chapter. Okay, that means everything is clear. But still, if you will have any question, please do not hesitate. Ask me. Okay, let's move further. Where was it? Okay, risk analysis. This is what we talked. Three different types of analysis we do to evaluate a certain project with the concern of the project. Okay, this is like sensitivity analysis, like we're trying each variable, changing each variable, how it affects. Then we move to scenario analysis, creating different cases like best, worst, and normal case, like recession, normal economic condition, and boom. And there is simulation analysis. We did it now. These are the steps. In here, even we could have drawn the normal distribution of the NPV, but we don't need it. We can even explain it by having these numbers, okay? If you wish, you can draw it in Excel, okay? The distribution of the NPV, probability distribution, but actually we don't need it. That information is more than enough for us to come up with a certain decision, whether you should accept the project. But with a purpose of illustration, with a purpose like making the fancy and beautiful, then you can go with the, so let's move further. We have real options. We have real options. Real options, they are similar to the things that are financial securities that are traded in markets. The logic kind of the same, like in financial market, we have call options, we have put option, we have warrants, and so on, similar. And the logic is here is that they give you kind of a right to undertake or not to undertake certain project, okay? Then we're gonna come. So real options will let the managers to make a future decisions that will change the value of the capital budgeting decision. That is made today, actually. And real options offer the managers flexibility. Actually, at the end, it will improve the NPV estimates for individual projects. We have different, there are actually many of real options, but there are some options that we're gonna consider. The abandonment options, this is the mostly famous and the popular one that allows the manager to abandon. Does anyone knows what does the abandon mean? Abandon?
Yes.
Leave.
To leave.
Yes.
Yeah, to leave, to kind of not to undertake, to exit. So to abandon the project, that means you leave the project, you exit the project, you reject the project. if the present value of incremental cash flow from exiting the project exceed the present value of incremental cash flow from continuing the project, okay? You will abandon the project in this case. When it comes to expansion and contractionary options, it allows to increase or decrease the scale of operation in response to demand. And the third one, we have got the growth options that allows to expand the scope of activities that capitalize on a new perceived opportunities. We have flexibility options that gives the managers a choice regarding operation and aspects. So there are two main forms of flexibility options. One is price setting, the other one is production flexibility. So the price setting allows you to change the price within the project. So when you make the project, when you make a prediction of the cash flows in a certain project, when you evaluate a certain project and you set up already one price, in some project it will not be allowed to change during the project life, the price itself, the price of the product that you're selling or you're planning to sell, so on. So in this flexibility of the options, it gives you flexibility to change it. It gives you the flexibility to change it. So that means if you have this option, which is set by a board of directors for you as a financial manager, then you will have a chance to change the price. Or if you have a production flexibility option that will let you to use different materials, inputs, or produce a different variety of products. So alternative treatments for analyzing the project with the real options. So use NPV without considering the real option. So if positive, the real option would not change the decision, okay? This is the case that you should keep in mind. If you have positive NPV, if you have a positive NPV, that should not change your mind. But if you have a negative NPV, then you should apply this real option to see whether maybe there's something very hidden and very like something that you cannot see now, but in the future you will be able to see. So using these real options, that will let you to come up with a rational and wise decision. So estimate overall NPV, it is project NPV without the option minus cost real option and plus the value of the real option it adds to the actual to this overall NPV. And then if you get a positive NPV, then you're gonna come up, yes, I'm running this project. Now, let us go with the example to make you to understand better what we are talking about. ABC Incorporation estimated that NPV of expected cash flow from a new production facility to produce yacht, okay? We are producing simple and classic yachts, okay? With a negative 8 million. So Black Pearl's production manager evaluating an additional investment. So he said, I need to get some additional investment of 5 million in equipment. That would give the management the flexibility to switch between the classic, deluxe, and elites like models of yachts. And of course, it will depend on the future demands. If there is a demand, then we will switch. If there is no demand, there will be no need to switch actually. So this option to switch the production among the models of yachts is estimated to have the value of 50 million. So now we are asked, evaluate the profitability of the project, including real option. Now, what we're doing here, first, we have 8 million is our negative NPV that we get it from this normal product, and we do extra work and we produce extra investment. Then we employ this extra investment and the cost is 5 million as well. But at the end, we know that with this extra investment, it's gonna add the value of 15 million. So to do this, it's just simple. Using this formula, the project of NPV, which is negative minus 8, minus the cost, which is 5 million, and the plus the value it adds after using this option. Remember this condition, guys. If NPV is positive, then there is no need to use a real option. If your NPV is negative, then we need to apply this real option issue. We apply it, and we come up that the overall NPV after employing the real option, it becomes a positive NPV. So without the option, the NPV production facility is negative, but however, we use the real option that increase the value, and that makes the project actually profitable. So this is the decision we can, but it's not obligation. It's a kind of right given to you. You can implement, and you may just decide to leave it. It's up to you guys. Okay, this one example regarding the production flexibility option. And let's use example of abandonment option. Let's say 3-year project given, cost of capital is 14%, the initial investment is 1,000, the expected cash flow is 400, based on the discount cash flows. Discount cash flow analysis NPVs. So if you put it everything numerically, it would be in this following way. So we have investment costs in year 0, which is minus 1,000. And in year 1, our cash flows is 400. So cash flow is what we receive. And at the end, if you calculate the NPV for this project, you would get minus $71.35. This is what it says actually, okay? And it's a negative. So it means that in here, we need to kind of apply the option as well to come up with a certain decision. So having this NPV, negative NPV, doesn't necessarily mean that you should reject directly the project. So use the options. Use the option, see whether it is acceptable or not. So suppose instead that we have more information on expected cash flow. So we have 3 different scenarios. There is success, there is a normal, and there is a failure. First, there is a 50% of probability the cash flow will be $200, and 50% of probability that the cash will be $600. So if it's failure, okay, in the case of failure, your cash flows would be the following: 200, 200, 200. And the probability to happen, the failure is 50, okay? And the success is 50. So in the case of success, it would be 600, 600. 600 here. So all cash flow would be 600, okay? But the probability is 50 to 50, okay? We're not sure, but there is a probability. So we have the options to abandon the project at the end of the first year and receive the salvage value. So once 1 year passed, at the end of this year, we can sell the project and receive the salvage value, which is $650, okay? This is our option. So option gives us this, okay? Then first determine the optimal abandonment strategy, then calculate the project NPV and the value of abandonment option using the strategy. So we need to come up with a certain decision. So our strategy would be the following. If abandon project, cash flows from remaining years, abandoned cash flow from the remaining years is less than, let me do it in this way. We will abandon the project. This is our strategy, okay? We will abandon the project We'll abandon the project if cash flows from remaining years, I mean after 1 year, okay, because we will sell it and get the salvage value $650 end of the first year, after first year, is less than our salvage value $650. So this is the condition. We will abandon the project if the cash flow from remaining years is less than 650. So we'll calculate the cash flow from remaining years, like from the second and the third year. If it's less than $650, then we will reject the project. If it's more, we will proceed with the project. Okay, this is the how we should make a decision regarding the project with a negative NPV. So what we do, we calculate the NPV. We calculate first of all the cash flows. We have to bring the cash flow from this year's to the year one, from here to the year one, and try to see and try to compare what happens. Okay. So, but keep in mind that we have probability of success and failure is 50-50. We're not sure. It's not 100%. It's 50-50. This is what you should keep in mind. Okay. So let's do it. So NPV 1. I'm putting 1 because we are bringing the present value of cash flows to the year 1, not to the year 0. This is NPV 0. We are bringing all cash flows to the year 0. Okay. Now NPV year 1 and NPV year 1. So what we do, we take the present value of this 200. Discount rate is 14%, which is 200 divided by 1.14, and to the power of how many years? 1, 2, to the power 2. Same thing with this. $200. So in total, so you should add these two numbers. You should add these two numbers. The summation of the present value future cash flows in the case of failure, how much it makes. If you come up and you will find out it equals to $329. That's what we find it. Okay. Then we do the same thing for this. And we compare, we see that it is less than $650 salvage value. Okay, but it's not the case of making decisions. We need to calculate the overall NPV with the probability. And here we have 600 over 1.14 to the power of 2. Let me take it in the brackets. And this 600 divided by 1.14 to the power 1. And in total, if you calculate and sum it up, you should come up with 987.5, something like this. Or if you round it up, it will be, let's round it, 88. So which is bigger than $650. So still, it's not the time to make decision. You will make a decision when you calculate the overall NPV. When you calculate the overall NPV, okay? And we know the probability of this is 50% to 50%. So 50% that it will be success, 50% it will be failure. So that means overall NPV is equal to, we need to calculate using the probability values. So 0.50 times NPV, we get it is NPV of failure plus 0.50 times NPV of success. Let me just make it bigger. Okay. So we need to calculate NPV of year zeros, NPV of year zeros for both projects, NPVs of year zeros. So in here, when we calculate, for year zeros. Why? Because we need to now compare the NPVs with what we get in the case of success when we get in the case of failure. So what we do here, NPV is equal to, so when we do it for the success, is that we're adding all the variables, okay? Like minus $1,000 plus 600 over 1.14 plus 600, 1.14 to the power 2 and plus 600 divided by 1.14 to the power 3, okay? And this all equal to $393. This is our NPV for success case, okay? For success case. But in the case of failure, that means you will not continue. You will use only first 2 years and you will just sell it with the options, okay? In case you're just realizing, liquidating your project after the first year. So minus 1,000 plus, open the bracket, $200 plus $650. And this all divided by 1.14 to discount to the year zero, then we will see what is our NPV in year zero. Why we're taking only 1 year? Because after the first year, in the case of the failure, we will not continue our project. We will just sell it, assuming we are selling it. And we are coming with a negative NPV, which is $254. Now we have different NPVs in here. Now we need to calculate overall NPV. NPV is equal to 0.50 times failure, which is minus 254 plus 0.50 times NPV success, which is 393. If you calculate, you should come up with the positive NPV actually. $69.50 on average. So your overall NPV is $69. So according to results we get from overall NPV, our decision should be to accept the project. To accept the project. Why? Because we get the positive NPV. Okay? Any questions?
I have a question.
Yes.
Can you please repeat from what did we get $988 in the case of success?
Okay, how we did. Look, we said that if project fails, we will sell the project. But when we are selling the project, we are selling at the end of the first year. But when we sell it, we receive this $650. That's why we are comparing with $650. So that means the remaining cash flows, we should bring them to the sale day, okay, to the sale year, which is year one. So that means when we discount this $600, we are not discounting to the year 0, we are discounting them to the year 1. Okay, we discount cash flows to the sale year of project. That means year 1. At year 1, we will sell the project. So we are discounting to the year 1. We are comparing with the salvage value. If it's more than 650, we accept the project. This is our strategy. And the same thing I did. So 600, this, plus 600, this, is equal to $988. This is what we get. Why? Because we discount the cash flow to the sale year of the project, which is year 1. So we do not discount to the year. We're not comparing with the investment cost. We are comparing with the salvage value. We do this with the purpose to compare with salvage value, if it's more or less. And the same thing with the case of failure. If it's less or more, we do the same thing with the case of failure. So we add this plus and in total we get this 329. So we're bringing to the year 1. We bring to the year 1 to compare with salvage value. We bring to the year 1 to compare with the salvage value. Is that clear? Did I answer your question?
Yes, thank you.
Okay. Now, let me just make it like this so that I can see everything. Okay, copy. I'll just copy this, just with the purpose to save it. Okay, it's here you go. Now, okay, this is what we get it. Okay, 69.5. So this is the main part. We concluded about the abandonment of the option. And this is all about the capital budgeting. And there are some pitfalls, some disadvantages of using the standard capital budgeting model that we do it now, like these 3 different risk models. First of all, it is not incorporating the economic responses into the investment analysis. It misuses the standardized capital budgeting templates. So basing on the investment decision on earnings price per share, the net income and return on equity. So using the IRR to make the investment decision, because the IRR has got the many pitfalls, and that's why they have got the problems. And it has a poor cash flow estimation, misestimation of the overhead cost, and using the incorrect discount rate. Why it's incorrect? So really, if you take these things into consideration and if you apply all the proper required features, then you will improve your budgeting, capital budgeting model by using the real discount rate instead of just creating different discount rate. So these are the actual pitfalls that should be taken into consideration when you run the capital budgeting. Do you have any questions? We are left with 3 minutes. I would like to stop here and continue tomorrow. If you don't have any questions, thank you so much for your attention. See you tomorrow. If you have questions, I will be pleased to answer.
Yeah, Professor, can I ask a question?
Yes, sure, go.
Is it right that we're having 60% on our first assessment?
That's true. We're gonna have the 60% on the first assessment. We're gonna have in general 2 assessments, assessment 1, assessment 2. This is the regulation of the register office. I received the last week that we should make 2 assessment tests. Assessment 1 will be consisting of 60%. Assessment 2 will be consisting of 40%. And
okay.
Assessment 1 will be on 8th of June. We have 2 weeks from now.
Okay, got it. Thank you.
Any questions?
I have a question
please.
about the management option. When we compare the cash flows after the year 1 to the salvage value, what if both NPVs after the year 1 are lower than the salvage value? Would we reject the project automatically?
Yes, automatically gonna be overall NPV will be less than 0 automatically. Your overall NPV will be less than 0. That means you should not accept that project. Okay, any questions? Okay, if you don't have any questions, thank you so much for your attention. See you tomorrow.
Okay, bye.
Thank you, Professor.
Goodbye.
Bye.
Bye.